Are you doing anything like that now? Are you actually shorting the market?
Well, I can't give out the exact position, but I can say that our exposure, as compared to 2 months ago when oil was at its all-time high, is much, much lower. So clearly, when oil was much cheaper, we were able to buy it. We rode the trend up to about 147. As a trend follower, we never try to pick the top, or we never try to pick the bottom, because we don't know how far the trend can go, how long it can last. So we for sure don't pick the actual top at 147. But as it starts reversing, we start to stop out of the position. So certainly we don't have to ride from 147 all the way down to 100. We lock in our profits much higher by having our stop orders in place. What will happen in the future is something that I can only predict. I cannot say for sure. But if there is an uptrend in oil, we can take long positions. If there is a downtrend in oil, we can take short positions.
Okay. Let's just say that if your boss thinks it's going to go to $200,
yeah.
So you could reasonably buy something that will fulfill that vision, right? Like pick a stock up that you say that, man, $100 is so cheap.
Yeah.
I'm going to buy some of these oil stocks or
yeah.
some, maybe even a futures position, but 5 years duration.
Sure, and perhaps we are doing some of that with our own proprietary capital, not with our actual managed futures fund. But it really doesn't make too much sense for us to buy oil stocks.
No.
Because if you buy any commodity stock, okay, you have a board of directors, you have a CEO, you have accountants who can all make mistakes, or they could intentionally make mistakes. Maybe an oil company is hedged its oil product, so you don't get a pure play on oil. For us, it's much smarter to actually have exposure to the physical commodity or to the futures contract, where you have more of a pure exposure to the actual commodity. Because we're interested in commodities because of the pure supply and demand issues. So I think it's much smarter to get exposure directly through futures or in the physical commodity than it is to trade any kind of stock.
But it's also more risky, right? Because you have very rapid price movements, and you can get caught out if you have a fairly significant position in any commodities.
I think this is sort of a misconception that investors have about futures. Yeah, if you put down a 5% margin deposit in crude oil, and it moves, half a point or a point, yes, you can have a huge loss very quickly. But there's no reason you have to put such a huge amount of leverage. You could fully fund that position. There's no reason to take that leverage. So
are you saying you don't do those high leverage?
No. In our strategy A, we're taking a lot of the leverage out of the futures contract by putting a huge position in cash. It means we take a 20% margin to equity. So roughly 20% of the assets are in futures positions. Roughly 80% of the money is in government securities like T-bills from Germany, Switzerland, US, whatever. Diversified government securities portfolio. And this reduces the risk inside the futures contracts. And using a system, we can manage margin in a very effective way. As compared to an individual investor, if you just buy 1 or 2 futures contracts and use leverage, then I agree, that's also quite risky. However, if you take out the leverage and you make a more diversified portfolio, then I think you can reduce the risk in a satisfactory manner. Certainly, in my view, you can make it so that it's less risky than buying a stock. In my view, the stocks actually have more risk. The typical company in the S&P 500 has a debt-to-equity ratio of 4 times. It means the average company, before you buy it, already has a leverage implied, because 20% of its value is stock and 80% of its value is bonds that they've sold to the market, so to creditors.
But your company, your fund, invests in stocks as well, right?
No, we are purely trading futures.
Oh, stock futures, okay.
So we are, even with stocks, we only trade the stock indexes. So for me, it doesn't make sense to trade, Chevron or Texaco, whatever, any kind of individual stock. If I just trade the stock index, because the individual stocks are correlating very high to the stock index, I have all the exposure I need to the stock market just by trading the indexes. We have a huge diversification of stock indexes we can trade. Obviously the DAX in Germany, the S&P or the NASDAQ in the US, but also in Asia, Hang Seng, Nikkei, Topics, SMI.
Do you trade any of the energy futures index? There are some indices and some ETFs that are dedicated to the energy space.
Yeah, generally speaking, we're not interested in ETFs or energy indexes, but we are trading the direct commodities. So like natural gas traded on NYMEX, crude oil, kerosene, unleaded gas, these types of contracts we are trading directly.
Right. Well, as we speak, the world financial markets are in turmoil. A few days ago, the U.S. government bought out the two giant mortgage funds. How do you operate in such an environment? And there's always this talk about lack of liquidity or people are not prepared to lend money. So how do you survive or even prosper in the times of dry no liquidity?
Yeah, I think it's a great question. I mean, how you perform when times are tough will define your future and define you as an investment company. This is normal for us because we've had tough times in the past, like in 97, 98, the Asian crisis. Our Superfund A was up over 20% in 97 and up over 60% in 98. We also have exposure, in September 11. That was also a very difficult period, but we were able to benefit from that. Not because we predict that such events would happen, but simply that we follow the trends. As there were very clear price trends that were negative in stock indexes, we could take advantage of that with short positions. As there were very clear trends upwards in commodity markets, we could take advantage of that with long positions. So this type of environment does not scare us. Actually, we like any kind of environment when there are nice trends to follow. Certainly, if you look at any other kind of strategy in the world, stocks, bonds, even real estate today, we're starting to see that strategies which are based on returns from paper assets are less attractive than strategies which are based on returns from real assets. In other words, we're going into a fundamental shift today where things like stock, a piece of paper, which has a theoretical value based on theoretical future cash flows, is not as valuable as a commodity, which is a real tangible asset, a real product that we can actually use. You can have cocoa and make your cocoa drink or coffee or
your fuel in the car.
Fuel in your car. These are things that we need. So actually, if you think about it, what do we really need? We need clean water. We need land, preferably land that can produce food or agricultural land. We need commodities. So we need soft commodities like sugar and coffee, etc. And we need gold. If you have gold as an investor, you really have what you need to protect the value of your net worth and to protect your purchasing power. Most investors don't realize that the US dollar lost over 80% of its value since 1971. In 1971, what happened? Besides the MAS being chartered by the government in Singapore, that's also the year that Richard Nixon, President Nixon, took the US dollar off the gold standard. So up until 1971, for the past 4,000 years, gold was the major currency. It was the major form of trade and exchange for all investors.